Hi, welcome to the March monthly video. I have not been very well. I had a bout of viral fever, so it has been a delay in making this video. So instead of wasting more time, let's get straight to it. So, the first question, obviously, for ha- this month has been around the banking sector, and if there is any impact of the banking sector in India, especially uh, with what we are seeing in the US. And secondly, the other question was related to the private banks in India and whether HDFC is better than ICICI vis-a-vis Kotak, or which one, or Axis, or which one is a better bank right now. So first of all, I think the Indian banking sector has been improving over the last 5 6 years. After the global financial crisis of 2008, what we found was, that sort of coincided also with the infra peak that we had in India between 2003 and 2008. And during that period, what happened was a lot of these larger banks gave out loans to the large infra projects like power plants and those kinds of projects, which at some point in time, because of completely different reasons, some because of coal linkages, some because there were uh, you know land not available, or those various issues, those projects got stuck, and the NPAs in the system sort of just ballooned. Uh, the last 5 6 years has been a period where most of the excess froth and most of the bad blood in the banking system has sort of been taken out. So now I think we are in a stage where the banking Indian banking system is perhaps at its healthiest in the last decade. And what we are also seeing is that after COVID, the credit offtake has also started taking up. Now, match that with the other fact, which is that India, the GDP growth has been strong, it has been sustained, and the best part of this has been that GDP per capita, something which very few people in India focus on or talk about. But ultimately, the thing which is perhaps most important is GDP per capita and the variance, right? It's not just the total GDP which matters. It is important that we have enough for individuals or people at individual levels, although there will be variances. But you know that has been increasing. So if you look at the chart on the right bottom, what we have seen is over the last decade, GDP per capita has actually gone up roughly two and a half, more than two and a half times. So that is something which is very good. Now, the other thing that we have to understand is that what has happened in the US or what is happening in Europe is essentially that they've been tackling zero interest rates for, or near zero, may not be exactly zero, but near zero rates for many years now. And all of a sudden, because of inflation and because of the fact that a lot of money was printed and handed out to people during COVID, what has happened is that uh, inflation has shot up. And now, obviously, the central banks are in a dilemma now what to do, whether to tame inflation, whether to uh, ensure that the banking system or the financial system is robust. uh, and it's basically, I don't I don't envy Jeremy Powell's situation right now, because he's basically stuck between the devil and the deep sea. uh, on one hand, there is inflation which is persistent, it's not going down. And on the other hand, uh, the banking system, or at least the small banks in US, are creating all sorts of problems and giving him headache. So whatever he does is going to impact one way or the other. So it's a big challenge. Now, what has happened in the US and in Europe is that, especially in the US, the rates have gone up from say 0 to 1%, levels, to 5% levels, or 4.5-5% levels, in about 6 months to a year. Now that is like you're increasing fivefold, right? And if I compare that with India, where we've hardly seen movement of 1.5% in the same time period, uh, and on the base of 6%, so we moved from 6 to 7.5%, whereas in US rates have gone from 1% to 5%. So you just see the quantum of jump, right? Now, if I just do a basic thing, right, I mean, 1 to 5% is like it's jumped 5 times, whereas India, if think what would happen if uh, the same thing happened in India. I mean, if rates went from 6% to 30%, right? So what are the first thing that would happen? You would take out money from your equity, you take out money from your existing fixed deposits, and you will try and put them in the new fixed deposits, which are going to give you 30%. Exactly, that is what is happening in the US. People are taking money out of their older older plans, and they're trying to get into the current getting into this current interest rate levels. So that is a very difficult challenge, uh, where when you look at it from the bank's perspective, they have taken money from people, giving them a certain return. They've parked that money with government bonds, in government bonds, in other securities. Now, mind you, in what we've seen in SVB is that it's not that they've taken that money from people and they've speculated with it, right? What they've put it in, absolutely good uh, bonds of the government. I mean, US government bonds. The problem is what they have is a ALM mismatch. I mean, asset liability mismatch, which is basically a time duration mismatch. So they've taken money from people, say, for 2 years, and they've put money in government bonds for 5 years. So if they can hold on to for that duration, they'll get the money and the interest in return. But the problem is now people are coming back queuing and saying that give us our money back, because we want to now, instead of keeping money with you at 2%, I want to keep money at 5%. So that is the big challenge. Now, in India, that is not happening. In India, we are actually seeing the opposite. We are seeing credit offtake. We are seeing uh, you know cleaner balance sheets, much more conservative lending practices than before. So with all this verification and uh, your credit checks and things like that have come in place, it's become much more, the processes have become much more stringent. It's not very easy nowadays to get uh, loans. So overall, I think structurally we are in a much better shape. Now, coming to the second part of the question, which is which bank is better, ICICI, HDFC, Kotak, Axis. I mean, all of these banks are very good. The entire banking system, uh, private banks is the best place I like in the banking system. I think within the banking, private banks, largish NBFCs, and s- some MFIs, right? Those are going to be the places to be in for the next 2 to 3 years at least. So you need to take your pick based on which one you like, whether it's HDFC, ICICI, or Kotak. I've always maintained that in banking, it's very difficult to understand the quality of the book, right? A lot of banking analysts or a lot of people will come and tell you that this bank is better than that bank. If you actually go down and uh, drill deeper, most of them haven't got a clue as to why they are saying what they are saying. uh, See, I mean, understanding the book been so easy, right, then we would not have had so many problems with banks, bank run, not bank runs, but banks collapsing or banks getting into trouble. Even RBI, when they do their uh, when they do their deep dives, etc., with certain banks, they're not able to figure out which banks are in trouble. It's only when there is a problem that sort of starts surfacing, that is when the regulators come in and then try to patch things up. Very rarely have we seen in the past that uh, you know RBI or any other agency actually proactively being able to figure out that, okay, there's been this problem. And why only RBI? I mean, I haven't seen uh, any report from any bank. I mean, any either brokerage or any financial institution which comes out and says that, okay, this bank has a genuine problem, etc. I mean, look at Credit Suisse, look at so many banks that has fallen, right? Before things were known to the public, how many sell reports were there, and those sell reports, I will discount those where it was only based on, if it was based on valuations. How many sell reports which questioned the banking assets and the core uh, position of the bank. You'll practically not find any. So the point is that when you're looking at a bank, what you need to look at is the management track record. Don't go to a bank where the growth is very very fast, uh, because most of the time the problems are back ended in banking, right? It's easy to give out loans, it's very difficult to get the payment back from the customer. So figure out which banks are doing conservative lending, what is the quality of management. So these are the softer things are in banking are more important, and that is why I tend to look for uh, banks which are stable, which are large, which has a good proven management track record. Okay. uh, Moving on to the next question. This is a very interesting question. uh, but this question is, in one article in a magazine, someone stated passive funds creates bubbles in market. What is your thought into this, and also what is your thought on the future of passive fund in India with context of same in the US market? So very interesting question. So first of all, I think the general understanding of passive funds is, just for clarity's sake, is it's an index fund. It could be a ETF or it could be a mutual fund. So anything which is basically looking at a broadly available index like Nifty or Bank Nifty, something like that, and or Nifty Next 50, and then it creates a basket of stocks, and it sort of holds that basket and tries to replicate the index. Now, any index. Now, if I look at Nifty, for example, it's basically a momentum index, right? Now, why do I say it is a momentum index? Basically, if you see Nifty, it is a free float market cap based index. Now, what that means is, any company which has a higher market cap, or the top, it will Nifty will have the top 50 companies with the highest market cap in India. Now, market cap is a function of the price and the number of shares outstanding in that company. So, number of shares outstanding is not changing, for example, but the price keeps changing, so market cap keeps varying. Now, if a stock performs, so think of the 50th position and the 51st position, right? So, if the stock in the 51st position performs better than the one in the 50th position, in the next rebalance of Nifty, those two will get replaced. So 51, the 51th stock will come into the index and the 50th one will go out. Right? That is how the rebalance happens. This is all done mechanically. There is no, one person or no committee which sits behind closed doors and decides that, okay, the next 6 months Nifty is going to have these 50 stocks. No, it is a quantitatively selected set of stocks based on the performance in the last period, right? Now, if you understand this, you will see that inherently there are some advantages and some disadvantages. The advantages is that it will give you a, a broad based exposure to the market, right? So if you are buying into, say, the Nifty ETF or the Nifty index fund, you will be owning the top 50 companies in India in whatever percentage that company, those companies are in that index. It is very easy to do. You don't have to fret about, okay, should I buy this stock or should I sell that stock or what. You just copy paste what the index is doing, and you are more or less sure to get an average return. What the market is giving you, you'll get that return. Okay. The next important part is, because of that inherent rebalancing which is part of that system, anything which is performing badly is going to go out, anything which is performing well is going to come in, right? The very nature of momentum, portfolio based momentum systems. Okay. And the another very important point is, whether a retail investor or professional fund managers, most of the time you will see that most funds, whether it is mutual funds, PMSs, AIFs, individual investors, most of the time you will see that they are not able to outperform the index, right? So there is obviously an inherent advantage of using a simple system to be exposed to the equity markets. Now there are disadvantages also. Now, for example, when you are invested in a particular index, if for example, if you want an exposure to the banking system, you are positive on the banking sector, you want exposure to the banking, you go and buy bank nifty bank nifty index fund. Now the problem is that I've given the current constituent, this is the current constituent of the bank nifty. If you see here, between HDFC Bank and ICICI Bank, they have more than 50% of that entire weightage, followed by Kotak Mahindra, which is 10%, Axis is 10%, and State Bank is 10%. So the top five is what, 20, 50, 60, 70, 80%, practically a little bit more than 80% probably. So five stocks, 80% of the index is done. So no matter what, even if let's say Bandhan Bank here and is 1.48%, even if it doubles, right? And if there is a slight correction in HDFC Bank and ICICI Bank, you will see that uh, your fund is actually performed pretty poorly, because the diversification or the allocation within that fund is skewed, right? So that is an inherent challenge uh, of any index. It's not Diversification is not thought of when they are constructing that in any index. There's no so in a broad based index like Nifty, there's no sectoral diversification that is planned for. It's just the top 50 of 50 companies. So that is one problem. The second problem is that when you have mindless index following, right? So if a stock comes into the index, everybody is going to come and buy. When it goes out, people will sell. With that, what happens is people tend to ignore uh, things like corporate governance, things like valuation, etc. Right? And then it becomes a problem. So recently we saw, what happened with Adani. One or two of the stocks were in the index. Now the index took a beating because those stocks were there, and irrespective of the corporate governance allegations or whatnot, there were challenges with the valuation. Even today, there are a lot of stocks in Nifty or in other indexes where valuations are not considered. So there is this tendency of ignoring things which, when you are doing bottom up fundamental investing, you would not sort of tend to ignore, right? Uh, the other problem with index investing is that it has a greater tendency of being caught up in both positive and negative spirals. So what I mean by that is, when things are going good, people will put in more money in the index, which means that the fund manager will deploy the money in the same set of stocks, which will create demand for those stocks, where the prices for those stocks will go up, which will create a better performance, which will pull in more people. So it becomes a positive spiral, right? And this is where I think this question of bubbles getting created comes from. So in this positive spiral, a sort of bubble gets created, and the exact opposite happens on the way down also, you know, which is what I call the negative spiral. Starts performing poorly, people sell. Selling means fund managers have to sell, puts pressure on the underlying stock price, performance falls further, and so on and so forth. So that becomes a big challenge. So in a nutshell, like practically in life and in investing, there is no, you know, yes or no answer to this question. Uh, it's probably, you know, somewhere in between. It At times it can create bubbles, at times it can create or it can pop bubbles, right? You have to use it to your advantage. People who are new to investing, I always suggest them that you start off with a, you know, start off savings with a broad based index fund. Once you are more comfortable with your investing and saving, then you graduate to you know, other things. But this in you know, in investing in index funds is actually a very good uh, way to start your savings journey. With that, let me, you know, uh, go through some, you know, some of the stuff that I've been tweeting out, and which has sort of been at the back of my mind for the last few days. So again, for people who you know, listen to me or read what I write, you will you know that I have been following China for many years now. And again, here what we are seeing is the story continues, right? And even recently, like, I mean, I think yesterday or day before, Putin and Xi Jinping had met. So again, we are seeing, we're staring at a bipolar world in the coming days, right? It's going to be the US led Western bloc versus China, Russia, and some of these other countries. These two are going to be the two predominant forces, and then we will have other countries, maybe India is one of them, which are going to be sort of equidistant or non-aligned uh, to both these powers. Now, but purely from a investing perspective, what we are seeing is that there is companies which are moving away from China. It's being slow, it's being steady, right? Again, I think yesterday I tweeted out that out of the 135 companies that have moved out, uh, opportunities, the highest numbers have gone to Vietnam, followed by back sourcing to the US, and India comes in at the third position. So, you know, this is the lay of the land today. This is what the context is today. China had built up its manufacturing might over the last 20 25 years, 30 years. Now is the opportunity for India to take that, or at least take a, you know, significant part of the global manufacturing supply chain. The reason I keep harping about manufacturing is because we are, you know, a country where we are putting up millions of new young people, and unfortunately not all of them are well educated to get you know, the small number of IT jobs or small number of you know, banking etc jobs, white collar jobs that are there. So we need manufacturing which can employ people in large numbers. So uh, in fact, we need to boost both the service and the manufacturing sector for India, and that's why this is an opportunity. I think as a country we should try and you know, just grab onto these you know, two things. I'll first come to the Paytm case. Again, right from the beginning, during the IPO, I've been saying that you know, most of these companies that have come, especially the new age tech companies that had come with an IPO, were obnoxiously priced. And for some of them they were not even very clear in terms of what their value proposition was, or trying to be everything for everyone. And and I just wanted to point out, in this Paytm case, uh, I remember during, just before the IPO, the CFO came on television and said that we've left something for the retail investor on the table when we are doing the IPO. And they priced their IPO at a price range of 2080 to 2150, and within a year they're doing a buyback at you know 546, 550 levels. So uh, what kind of management credibility do you want to give to the management is something that I will leave to you as investors. But these are small things that we should notice and keep in mind as investors when we are investing in this company, because uh, companies can change, but the people or their behaviors tend to remain the same, right? And the last one, this was a very beautiful story I read, and it just goes so well with what I personally believe in, which is that a lot of things in life happen by chance, right? So this story was about Kyoto, the city in Japan, which was shortlisted as one of the cities that was supposed to be bombed with a nuclear bomb during World War II. Now, what happened was that the US Secretary of War, Henry Simpson, had visited Kyoto during his honeymoon, and he loved the place, he loved the city, he loved the people, he loved the culture of the city. And just because he had witnessed the people, and it was just not a name, in a map of a distant country, uh, he he took that name off the list. So just imagine, this is a city with millions of people, or at least tens of thousands of people living, who are completely unaware of somebody who had maybe come to their city, uh, you know, a few decades back, actually make a decision sitting half the world away that would impact them and their children and their grandchildren for the next 40, 50 years. Their entire lives would have been different, or probably they would have been dead, and the entire history would have been different, unless for that one simple random fact, right? So a lot of things that we later on ascribe uh, reasons to are just random in nature. So I'll end today's this discussion with pointing you to one of the best books, or perhaps the only good book. Again, this is probably a little bit controversial statement, but Nassim Nicholas Taleb and controversy sort of tend to go hand in hand. The only good book that I think Taleb has written is Fooled by Randomness, and this is one book that everyone, uh, whether you are a serious investor or not, should read. It's just fantastic, and a lot of that comes through in these kinds of small anecdotes about life. So with that, I'll stop for today. Thank you for sending me your questions. Do keep sending me more of questions, and we can continue with this next month. Thank you.